A news alert from OPEC this morning. The group is now cutting its 2020 oil demand growth forecast, citing the impact, as you might imagine, of the coronavirus. This is the sixth time now in 9 months that OPEC has downgraded its demand outlook. It's also lowering its global economic growth forecast to 3% for the year. And speaking of oil, energy is the only S&P sector in decline right now, down about 11% year to date. Joining us to discuss whether this is the push towards ESG contributing to that decline in oil stocks or something else. Amundi Pioneer CEO Ken Taubes, he manages $92 billion in assets for that firm and is one of the first movers in deploying socially responsible investment criteria. Ken, you look at what's happened to the energy sector in terms of the stock price. How much of that do you think is a function of the move towards ESG among some of the big investors?
Well, I think the sharp drop this year is clearly clouded by the coronavirus demand cuts that are just forecasted and heard from OPEC. But longer term, I do think you see in the numbers quite an impact from investors who are moving out of energy stocks. In fact, this is even more pronounced in our view in Europe, where you see quite a difference in valuations for large European oil companies versus U.S., even cheaper in Europe, frankly, by many turns and multiples. So this is a very big long-term factor, yes.
Ken, I don't know if you saw, but about a day and a half ago, Georgetown University announced that they were going to divest all of their fossil fuels. Do you think the divestiture strategy is a good one? Because I have very mixed views of it personally.
Andrew, I think that this is a value judgment investors are making on their own. And in our open-end mutual funds, where we have all comers of all persuasions and political views, we don't want to take a political view. But we do make judgments about which energy companies are doing a better job than others in the ESG criteria, whether it's carbon capture, water usage, and so forth. So I think you can pick better energy companies. The risk of complete divestiture is that if the stocks rebound for a period of time, demand's better than expected, you can lag quite badly
also,
against
to me, there's
a broad
two issues.
index.
There's the lagging issue, which is a real and genuine conundrum. But the other issue, which is that to the extent that Georgetown has a view on this, if that's their view, that they no longer have a seat at the table, which is to say that potentially what you could try to do is invest in the companies that you think are actually on their way and making the journey to sustainable energy, if in fact that's their ultimate goal. And if they can push some of the companies that are going that way to go there faster, potentially it pushes the rest of the industry. Once you say you're out, and you have no voice left.
Absolutely. And I would say this is related to another important subject. The engagement topic you're talking about is very important. In fact, we ask our analysts to engage in companies to educate them, because a lot of companies don't even understand what these criteria are. But there's the other issue. As the stock prices go down, the cost of capital for these companies is going up. And if you have a company that wants to transition, and you see this in the utility business too, companies that want to get out of coal, if you keep raising the cost of capital for the transition, are you really helping the country? Are you really helping these companies transition?
Well, that to me is the question. If everybody divests tomorrow, I'm not sure. First of all, for better or worse, we are going to need fossil fuels for a very long time, unless you think that we're going to start building nuclear energy plants around the country at a rapid pace.
And strapping them on the back of an airplane.
Well, absolutely, we do not, and think that divestiture is a completely good idea. In fact, we don't have that strategy. Our objective is total return, number one. Those are our investment objectives as outlined in our guidelines. And we just try to choose the companies that are doing the best in transition and managing the problems of carbon emissions and so forth.
Like which companies?
Well, we don't. You could look at our holdings. We publish our holdings with a 30-day delay. But frankly, there are companies within the energy sector that are much more progressive, and particularly when you look at fracking. This is very positive for the U.S., but there are issues with, frankly, water usage. And if you look at some of the companies are doing a much, much better job of managing water near aquifers and so forth. So you have to really engage with the companies, as you suggested, and understand what their strategies are, what they're doing to minimize the impact of their activities.
And, well, so my worry, as you might imagine, is that people are going to either divest on an individual basis or on a large institutional basis, and to the extent that you're actually trying to move things forward, that it doesn't happen because the cost of capital goes up. From a policy perspective, what do you do about that?
Well, from our perspective, we, as asset managers, and not as the CEO of the asset manager, but as a CIO, we have different strategies for different types of investors. Now, as I said, in our open-end funds, we don't have a divestment strategy. We have a strategy of picking the best companies. But if other investors came to us and said, look, we want to invest in companies that are helping on decarbonization, having an impact, we can do that as well. So I think it really depends on the investor goals.
You're conflating water usage and particulate pollution and chemical waste and all these horrific environmental things that obviously we would like all energy companies to be involved with clean water and renewable water and everything else. But you're conflating that with the ability of a hydrocarbon-based company to somehow not emit carbon. And you can, carbon capture is de minimis at this point in the industry. So
absolutely.
Well, either you acknowledge that there's still going to be CO, and I don't, now I'm doing it. Now I'm calling it carbon instead of carbon dioxide. But either you think it's okay to continue to use hydrocarbons either with natural gas or jet fuel or however you do it, or you don't. And if you don't, then start walking the walk, sailing across the ocean, walking to work, all the other, no cows, all the things that you want to do instead of the happy talk about, oh, well, we, water this and water that. Either you think hydrocarbons are still going to be around or you don't.
Look, I think that carbon and oil and energy and gas are going to be here for many decades. And our objective is
from
not
that.
to...
How do these companies that serve this very important purpose in making the world run, third world countries, heating for people, the quality of life that we enjoy, how do we divest from them and leave them on their own to provide the world with energy?
Well, you're ascribing things to me that I didn't say. In fact, I said in our funds we don't divest.
Don't go halfway. Either go all the way or don't. You're either really woke or you're just talking woke.
No, what we are is investors and trying to buy the best companies in each sector. And therefore, you can discriminate on which investments are better than others. And that's what we try to do.